Diversification is a common buzzword in the financial community, but does diversification really matter in your TSP account? In this video, we address this common question about diversification. That's coming up, so stay tuned. Hi, I'm Jerome Harvey with Fedway Financial, and this is the Money Briefing. On this channel, we cover topics related to personal finance, federal benefits, and retirement planning. So if you're new here, please consider subscribing. Have you ever spoken to a financial planner, read an investment book, or watched a YouTube video about investing? It's very likely that you heard the term diversification mentioned a time or two. It's one of those words that is thrown around a lot, but in the context of investing, what is diversification? It's simply a strategy of spreading your portfolio across different investments so that your exposure to any one investment is limited. Many times, those investments may behave and react differently to the same event. Diversification does not guarantee your portfolio against loss, but it can help reduce volatility and lower your exposure to different types of risk. When it comes to investing, there are various risks, such as market risk, inflation risk, interest rate risk, and country risk, to just name a few. But out of those risks, the one that receives the most focus and attention in the TSP is market risk. If you consider market risk on a scale of 1 to 10, with 1 being least risky and 10 being most risky, a lot of TSP portfolios are either a 1 with everything invested in the G fund, or it may be on the other side of the spectrum as a 9 or 10 with all the money invested in the C fund or S fund, or in some type of combination of those two funds, such as a 50-50 split or an 80-20 split between the C and S funds. And while the two of them together do provide some diversification among large, medium, and small cap stocks, they do not provide a lot of protection against market volatility. So the bigger question is whether diversification really matters in the TSP, especially given the fact that the Thrift Savings Plan has historically only offered 5 core funds. And quite honestly, diversification may not matter in all situations, but there are times when diversification matters. So let's review some of those times. Diversification matters if you have a moderate to low risk tolerance. Here are some indicators or warning signs that you may have a more moderate or even a low risk profile. If you treat your portfolio like a seesaw, then you're probably not a 9 or 10 on the risk spectrum. What do I mean by a seesaw? When the market is going up, you load everything into the C and S funds, but when the market trends downward, you transfer everything to the G fund. This back and forth often creates more harm than good because many investors end up selling and locking in big losses. Then they get more aggressive only after the market rebounds. But unfortunately, they often miss out a lot of the upside growth. You may also have a moderate to low risk tolerance if you constantly check or worry about whether your portfolio goes up or down in value. It's definitely okay to have a general interest about your TSP performance because all of us want our portfolio to do well, and you should check your thing in your portfolio periodically. But if you're looking at your investments daily or weekly, and if you become anxious every time that you log into your TSP account or when you hear negative news about the market, then you likely don't have the appetite for an overly aggressive portfolio. And then lastly, if your main objective is protection and preservation of capital, then it's probably obvious that you have a moderate to low risk profile. In addition to your risk level, diversification matters if you have a short time horizon until you need the money. For example, if you plan to start withdrawing from your TSP within the next 5 years, diversification can help minimize the effects of a market downturn. Markets can be very volatile in the short term, and market losses can occur suddenly and be severe. At times, markets can recover losses pretty quickly, but at other times, it can take 3 or 4 years to fully rebound from a market downturn. And it's not always a 1-to-1 ratio between losses and gains. If the market declines by 10%, it takes an 11% gain to recover. And if the market falls by 20%, it needs a 25% increase to get back to break even. And as you can see in the chart, as losses get larger, the return necessary to recover to break even increases at a much faster rate. A 30% decline needs a 43% gain to get back to the level before the drop. And you can also see the returns needed for a 40% and 50% loss. This is one of the reasons why managing risk is important as you get closer to withdrawing money or if you're already retired and taking distributions. Unfortunately, it's typically not prudent to just park everything in the G fund because your portfolio may not grow enough to offset the distributions and inflation, which can accelerate the drawdown of your TSP account. The last question that I want to address is how do you create diversification in your TSP? If you're not comfortable with selecting your own allocation, the easiest way to diversify your TSP account is through life cycle funds. Sometimes people may dismiss life cycle funds because the funds assume that all people in the same target range have the same risk tolerance and financial goals, which we know is not necessarily the case. However, you still have the flexibility to invest your TSP more aggressively or conservatively using life cycle funds. For example, let's say you plan to retire and start withdrawing funds around 2040, but you want your portfolio to be a little bit more aggressive than the L2040 fund. You can choose to invest in the L2050 fund, or if you want something more conservative, you can select the L2030 fund. By simply moving out or moving in your target date, you may identify a portfolio that's more in line with what you want. As I mentioned earlier, diversification in your TSP may not matter as much in every situation, such as when you have a high risk tolerance coupled with a long time horizon, but there are definitely situations when diversification matters in your TSP account. If you received any value from this video, please click the like button. Also, if you have any questions or responses, you can add them down in the comment section. Thanks for watching, and we'll see you on the next Money Briefing.